Hey guys, welcome back to the channel. So today I would like to give a brief introduction about private equity, and let's try to understand what exactly is the private equity and how it's gonna operate its business. Basically, private equity means capital investments into the companies that are not publicly traded, and we can term private equity as an alternative investment class. And when we say it's an alternative investment class, which means it's not a conventional investment type like what we do in the equity and mutual fund and gold investments. Let's try to understand the salient features of a private equity fund. So as I said, it's a collective investment scheme which invests in non-publicly traded companies. So it's majorly available for institutional and accredited investors. When we say it's an institutional investors, it could be banks, insurance companies, it could be mutual funds, pension funds, or any hedge funds or any endowment trust for that matter concern. And when we say accredited investors, it differs from country to country. Let's take for an example of US. We call an investor as an accredited investor if his net worth exceeds 10 million. I'm sorry, it's 1 million, or his individual income exceeds $200,000 for the past 2 years, and including his spouse income, it has to exceed $300,000 for the last 2 years. And this is the definition of an accredited investor in US. It could vary from country to country. And private equity is generally a closed-ended funds. Not generally, will definitely be a closed-ended. We won't be having any further subscriptions or redemptions as we do in mutual funds. We won't be having all those stuff. It's a closed-ended fund basically, and the fund will be set up by a private equity firm. And the most popular private equity firms are Blackstone, the Carlyle Group, KKR, Walsberg Pincus, TPG Group. These private equity firms will set up their own private equities funds, and accordingly they will pool the money from the institutional investors or accredited investors. And once the amount has been pooled, they will invest in the companies which are not publicly traded, which means they will invest in the privately held companies. They'll seek the money from the investors, and investors who are willing to be part of these funds will give a commitment. And I will discuss commitment, what is a commitment and all, in the further series of this video. For the time being, let's try to understand in brief how exactly a fund will be set up and how it gonna operate. So the fund manager will call up the money, and the investors will be paying the money to the fund, and the fund manager waits for an opportunity, and if he gets the opportunity, he will invest in those companies. And of course these will be the privately held companies, as I said earlier. Then he will identify the companies which have potential to grow and which are not performing so well. The companies may be financially strong, but the management could be not that good as how financial statements are projecting. So in that case, private equity jumps. They invest in the money in the fund. They will buy out some stake, maybe controlling stake, and they later makes few changes in the composition of board of directors, and they gonna operate the company. And once everything is all set, they will exit the investment. They'll sell out the investment to the other private equity or maybe some other investors who are willing to buy the shares of that company, or they have another option of going into the IPO, initial public offer, and they are going to sell off their, they are going to float off their shares to the public. Whole life of a private equity fund can be segregated into four parts. And the first part will be basically formation, and the second one will be investment, third one is harvesting, and the fourth one is extension. And of course, I would add the fifth as exit. So let's try to understand step by step how a private equity firm can be formed. As I said earlier, the private equity firms will set up a specified fund. They will draft the legal documents, which includes limited partnership agreement. I'm sorry, I forgot to mention you. The private equity fund will be established as a limited partnership. It is not a company, or it is not a unlimited liability partnership. It's gonna be a limited partnership. And the other legal documents will include private placement memoranda and subscription agreements with the concerned investors. And with these legal documents, they will approach the investors, and who are all the investors who are willing to invest in that fund will give a commitment to the fund that so much of money you can be expecting from me. So once the fund manager feels like, yeah, we have achieved so much of money commitment, so we can perform an initial closing. So what's initial closing basically? So initial closing is nothing but the locking of the investors uh, who have already given the commitment. It's something like the acceptance of the commitment by the fund. So they'll perform an initial close, and the fund manager will determine what's the share of commitment given by a single partner or single investor. Likewise, he performs all a tabular form, who has all given the commitment to the fund. He will determine the percentage of commitment value. I'll try to describe in briefly in the further series of these videos, but let's just jump in the next section of life of the PE fund. So it's an investment. So after formation of an fund, the investment period could vary from 1 year to maybe 3 4 years, could be 5 years as well in few cases. So during this time frame, the GP, the so-called GP, general partner or the fund manager, will identify the potential companies. He will invest in those companies for seeking better returns and for seeking good capital appreciation. And once this is done, the next part is like harvesting. In during the harvesting period, they slowly disinvest the investments what the fund has made. They'll realize the value, they'll sell off the assets, they will realize the money during the harvesting period until 10 years from the date of the formation. And what if the fund couldn't realize all of its investments within the stipulated 10 years of time frame? So it will go for an extension with the permission of all the investors, and it could vary to minimum 2 years, and it may go beyond 3 4 and 5 years as well, and that depends on the agreement between the limited partners and the general partner. Don't worry, the terminology may look relatively new for you. You could not be understanding what a general partner and what a limited partner is. I'll try to make the another video about these terminologies, and I'll briefly explain you what all these things. So they'll at the end of the day, the life of a private equity fund will end at the exit. They'll sell off all the investments, and they will distribute the amount realized to the investors, and that ends the life of a private equity fund. And please don't forget to subscribe my channel. You will be getting a series of these videos. As of now, I have done it on private equity, and I'll make a couple of more videos. This is not the end of a private equity section. We do have a couple of videos coming in near future. Please catch me at the another video. Until then, see you, goodbye.